Navid Abghari joining us from Angel Oak. I think we got you there. All right, so Navid, we've had big breakouts in some of the banks, but I think there's been this concern that it needs to be confirmed by higher yields. Now what we've got is a big blockbuster employment report. How good is this for financials?
I think it's a strong number, and it's definitely a continuation of a theme that we expect to really lead markets into 2020, and that is the strength of the consumer. Not only the jobs number this week, but the claims number the prior week. Obviously, unemployment back to 1969 levels, average hourly earnings up more than 3% year over year. All this points to a very strong consumer. I think the strongest point to make is nothing that was in the numbers today, but generally the consumer has really delevered since the last crisis. And if you look at household debt to GDP, it's really the lowest it's been since 2001. So what we think is that taking exposure to the consumer is still a very attractive play in this market, especially when compared to other risk assets like the non-bank corporate sector that's really at all-time leverage highs. And this is a much more attractive risk return in our minds.
Now, the story for rates, obviously a lot of people talk about the yield curve for banks, all that, but there's also, as you point out here, the consumer and employment situation means loan volume as a whole should remain pretty strong. What's the best way to get exposure to that? Do you want regional banks, or do you want to just go to the charts and find out which stocks overall broken out and follow trend?
I think really to be able to extract true value in this market where many assets are trading rich, it's really going into the weeds and trying to find those attractive valuations. I think the beta trade really is coming to an end. I think this is the part of the market where you need to be able to be much more selective and balance risk and reward. And I think that's where you can go into some of these regional and community banks and still find value.
Where are those that have not yet reflected this? Is it across the board? I mean, we've seen while the big financials have broken out some of the charts like JP Morgan, Bank of America, and others, a lot of these regional banks seem like they've been waiting on a sign. So is this the sign?
I think that definitely is a play into it. I think that this is an opportunity, especially when compared to the broader market and the opportunities you see elsewhere. I think they still look attractive on a valuation perspective. But I would even point to another way to play the trade, and that's really looking at the debt side of these same entities, where again, given the regulation and the deleveraging in the system, being able to go into the debt of these banks where debt is much more a function of volatility minimization than profit maximization, is something that we think is very attractive in this market.
So how does your fund then break down on the financial side, equity versus bonds?
We're actually very strongly allocated towards the debt side. In fact, I would say more than 90% allocated to debt with only a smattering of equity. I would say our equity allocation is much more tactical in nature, again, to take advantage of some of those stories that we see. But really the broad-based theme that we think is attractive today is the debt of community banks, where again, banks have increased their equity ratios by more than 30% since the last crisis, and non-performing assets are back to pre-crisis levels. And all that bodes very well for the debt of community banks.
If you like the debt situation, and if you like the balance sheet situation, Navid, one of the cases that we've offered up here that I think looks pretty decent still is that there might be sort of a port in the storm, even if things do slow down a little bit, that banks this time, regulatory changes are going to be a place to maybe hide out if things get dicey, but also perform right if the economy remains strong. Is that the case?
I think you hit the nail on the head there. That is really where the ultimate value comes, is how this sector can perform in a potential downturn. I think being very mindful of risk return, and not just the return side of the equation, but also the risk side, is where real investors will be differentiated over the coming years.
Yeah. All right, Navid, really good stuff. We're going to do a little trading here. Appreciate the insight. Navid Abghari, Senior Portfolio Manager at Angel Oak Capital Advisors. So the case here kind of is nice because you've got days like today where they like the yield curve, Tom.
Right.
They like what's happening with bonds. But then if you look at it on a long perspective, they've got a little bit of a backstop because they're healthy and they haven't taken on as much risk.
Yeah.
So if you want to trade long on this, all right, let's go to the regionals, okay?
Yeah.
Shorter term, they're the ones responding. What do you think? How would you do it?
If you look at KRE, it's underperformed, the financials in general, just like the Russell 2000's underperformed, and financials are a big component of that. But you look at KRE, it's that regional bank ETF. It's got designs National Bank Corp. It's got Regions Financial, some of these others, PNC, some of these smaller regional banks that should do well based on what we're seeing as far as jobs, the economy, and consumer spending. How do you play that to the upside? So I went immediately to the option market as opposed to just buying KRE outright.
Okay.
And what I kind of created here was a bullish strategy, Oliver, to take advantage of maybe playing catch up here with KRE, where I'm buying the January 57 strike call. So you got about 42 days to expiration, so relatively short term, about a month and a half. You buy those calls, and to finance the purchase of that call, which is a bullish call, you sell the 56.54 put vertical, which is also bullish in stance. So you collect a credit on the put vertical and you take a debit on the strike on the call. So you reduce your initial debit on this particular trade by selling the put spread to finance the purchase of the call. You pay roughly about a 75-cent debit on this. That takes the break even up to about 57.75, which is less than about 50 cents above the current share price of KRE. So in a strategy like this, Oliver, you take advantage of the upside, any upside move in KRE, but then you also define your risk on the downside a little bit. Instead of just buying KRE or buying the straight call outright, you reduce the initial price on the trade by selling the puts vertical. Right. You're still risk defined in case something does happen over the next month and a half where we start to slide, but you take full advantage of the upside on a trade like this because you're buying that at the money call.
The move on KRE is pretty beast today. It's up 1.8%. Right. Spikes at the open, hasn't changed since. We're seeing bonds, kind of waffle after their initial drop.
Right. And I think that's actually healthy. Bonds starting to settle down here because if we get those interest
sentiment
rates
in 5 minutes.
Yeah.
Okay. Consumer sentiment, if that's big too.
Yep.
Maybe another leg down.
Maybe another leg down for treasuries, another pop in the yields. I think that the key thing in this market for the equities is if we don't, and Kevin and Hinks and I were talking about this before I came on, if we don't get that spike in yields where we get that 10-year up to 2% too quickly,
right?
I think if they stabilize maybe about that 1.9% level for the 10-year, then we could continue to see equities rise here.
Okay, now on the other end, let's say you think this is all, bubkiss and that the reflation situation is baloney, because there's plenty of people who believe that, okay?
Yep. Less today.
Definitely fewer today, for sure.
Yeah.
But that being said, you could go to the banks and you could pick something that's rallied a lot, to your point earlier about JP Morgan. So let's take the other side of this, all right? Let's be fair. What if you want to fade JP?
Well, if you want to fade it, now, that being said, initially you look at this and you're like, oh, it's up 38% year to date. It's technically getting overbought on the RSI level if you look at technicals. But if you want to take that stance that, hey, maybe JP Morgan, this massive rally, is going to start to stabilize a little bit, and you want to do it ahead of earnings. They have earnings on the 14th of January. Right. So I took that into consideration with coming up with a way to take advantage of some stabilization in the shares. Maybe they start to consolidate here a little bit around 135. And what I created was a short iron condor, or you can call this an iron butterfly because we got a same common strike in the middle, where I sell the January 3rd weekly, I sell the 135 calls and 135 puts. Now, that's a naked short strangle. I don't want that. I want to stay risk defined in case the stock does move away from 135. And then I buy the 130 puts, I buy the 140 calls. So each wing of this iron condor or iron butterfly, $5 wide. You collect $3.40 credit on that. You can see the apex is there right at our short strike, the 135. But our break even's 131.60 to the downside, so plenty of room to the downside, nearly $4 that way, and then 138.40 to the upside, so just about $3.50 to the upside, that you can have this stock consolidate within that range over the next 28 days, and time decay or theta takes advantage of selling a credit spread like this, where the prices of this iron condor reduces and contracts on a daily basis because of time decay or theta. So that's a way to take advantage of a consolidating stock, or maybe if your expectation or assumption is that it's going to remain between those two break-even points over the next 28 days.
So it doesn't keep just rallying, basically, betting against a further big blowout move to the upside.
Right, but you still have a cushion on both sides, which is nice.
All right, let's talk about what's not working today. Thank you, Tom White. Again, thanks to Navid Abghari.